Well, good afternoon, everyone. Welcome to the Africa Global Funds educational series, where we're going to talk about African equity investing and what lies ahead. What I'll do first is just introduce the panelists so that we can allow others to join with the sort of delays that occur with these sort of online experiences. And then we'll go straight into discussing the markets. So firstly, we have Dr. Eyal Salami, who's the Chief Investment Officer at DUE. He is in charge of their liquid Africa strategies, and he's been involved in researching the African financial market since 1998, when he worked for Nomura. There he was a senior equity analyst covering Africa, so has really been there since the start of this phenomena. He initiated Nomura's coverage of the region and of the years, has substantial knowledge and experience of African economies and companies. Dr. Salami has been named Chief Investment Officer of the Year, and he has also has substantial experience as a practitioner in the African financial markets. He's published in a number of leading academic journals and has also focused his academic research on synergies and corporate takeovers. He's also a chartered accountant and has previously worked as an auditor in
the dear viewers and speakers, I believe Daniel got kicked off and I think he's joining right back on, so please just give him a second and we'll resume as scheduled.
Right, I'm not sure how much of that I was speaking to myself and how much I was speaking to everyone else, but I was busy going through everyone's bios. I think I'm now just on to Richard's bio, and he's a portfolio manager at 91, and there he's responsible for Pan-African equities, and he joined the firm as an analyst in 2012. Effectively, he's been working in the financial sector with prior to that at ABSA Capital, and he has had previous awards as one of the top analysts at BJM Securities, as well as winning awards from Financial Mail analyst rankings. He's a CFA charter holder, and he's also a chartered accountant. So very well qualified panel with a great deal of experience behind them. So what are we looking at? We're looking at the African equity investing and what lies ahead. Now, obviously, we are all aware with what's happening in the world, but let's start on a positive note. 3 million people have recovered from COVID-19, and in fact, due to global lockdowns, some 30 million people have avoided getting it. Unfortunately, there's been an economic impact, and that economic impact in developed markets has been addressed by perhaps the biggest injection of liquidity into capital markets that has ever been seen, even surpassing that in 2008. That injection of liquidity followed, obviously, the response of equity markets effectively recognizing that the slowdown resulted in a supply side as well as a demand side shock effectively over the whole world. Equity markets had a very sharp correction to the downside, indeed far sharper than, for example, the 2008 correction. However, that liquidity lowering the discount rate has been seen by equity markets as effectively justifying higher valuations because, as everyone knows, we're not facing Armageddon, we're just effectively going into a period of slower economic activity as a result of preserving our health. So not only did we have this dramatic drawdown in equity markets, but we had a dramatic recovery. Now that dramatic recovery from the liquidity, you can argue from an efficient market point of view, has some basis in developed markets. But the question really becomes, does it have the same basis in emerging markets? And certainly, does it have the same basis in Africa? And that's really what we're here to discuss today. So what I think we'll do is we'll go straight into the panelists, and we'll ask each of them to effectively, for 2 to 3 minutes, just give their take on how they have weathered what's going on, and then we will move on to delve into some of the more specific issues affecting equity markets and also economies. So I'll go in the order that people are shown on my screen. It might be shown differently on everyone else's screen, but Richard, you are first in the pecking order. So if you would like to have 2 or 3 minutes to just give some insights. I think you're still on mute.
Can you?
That's it.
Apologies. Thank you very much. I'm actually getting feedback now, but I'll carry on so long as it doesn't disturb the rest of the webinar. So to answer your question as to how we fared, we feel we fared quite well. Fortunately, we were invested in relatively defensive equities and were carrying a relatively large cash position in our portfolio, which has put us in a position now where we have started to selectively deploy some of that cash in some equity holdings across the continent. But the answer is, of course, as you've seen, global equities have been really tough. You spent some time referring to the recovery that we've seen across the globe in equity markets. However, we actually haven't really seen much of a recovery across African equity markets. And during the course of this webinar, I'm sure we'll get into some detail as to why that is the case. In each case, arguably you get a company-specific reason, a sector-specific, or a company-specific reason. But in short, it has been a tough environment. You've had to navigate the global impact or the impact of the slowdown on the rest of the world and Africa, rather than the types of impacts that you would have seen in other markets. So in other markets, investors would have been more concerned about the immediate impact of lockdowns on those economies, whereas in Africa, broadly, we have had lockdowns, we have economic, sure, but the real impact is about how the global slowdown impacts remittances, impacts tourism flows, and impacts the continent's trade with the rest of the world.
Excellent. Thanks, Richard. So let's move on now to also some insights from Jenny, who also entered this with a fair amount of cash, from what I can see. We also need to have you unmute.
Apologies. Can you hear me now?
Yeah.
Great. Well, thank you so much for the introduction, Dan. And yeah, we also have weathered this somewhat unprecedented situation fairly well. We're actually 12% ahead of the index, having gone into it quite quickly with a fair amount of cash, as you rightly point out, which, a bit like Richard, we've started to deploy rather selectively into sectors where we think will be better performing and potential beneficiaries, and some of the more defensive sectors. So really, we, I guess, prefer from a sector perspective the telcos, which is fairly obvious, the payment platforms, e-commerce platforms. And it's been interesting actually to see, from my perspective anyway, how we have seen some of the solutions that we've come up with, which Africa hasn't really had for the last mile. And so it's been fascinating speaking to some of the corporates about that. East African Breweries, on one of their conference calls, was talking about using the borders, which are the motorbike taxis in Kenya, for a last mile solution. And so those are the kind of opportunities that we've been looking at. And then some of the more defensive sectors, the food producers, and potentially food retailers. I think just quickly from a geographical perspective, we are probably more confident about the recovery in some of the North African countries like Egypt, Kenya also, because a lot of the banks there also went into this with quite a lot of cash on their balance sheets and fairly liquid balance sheets. Although generally I would say that Africa has probably gone into this crisis in a slightly worse position than we saw going into the global financial crisis, unfortunately, with slightly weaker country balance sheets and higher debt levels. So we also, like Morocco, although we still continue to struggle with the perennial question in Morocco of valuations. And I think just slightly negative, we have concerns still for countries like Nigeria, which obviously is facing a double whammy from commodity prices, obviously significantly lower oil prices, and also a healthcare crisis at the same time. and a peg currency, you can almost say it's a threefold problem, where the currency is partially pegged to the dollar as well. But I think just collectively, I think the continent is likely to weather the storm. If you're looking at the GDP forecasts provided by the IMF and World Bank, they are significantly stronger than we've seen elsewhere. For example, I think the Europe down GDP forecast for 2020 is negative 10%, the United States negative 8%, Sub-Sahara, and really weighed down by the heavyweights of South Africa and Nigeria. But on the whole, the rest of Sub-Saharan Africa is actually looking to weather the storm fairly well, with some countries like Senegal, 3% GDP growth, Egypt again, 2% GDP growth forecast. So we're cautiously optimistic that we'll see a strong recovery as well. But I think we'll probably get into the debate of that. I don't think it's going to be an even recovery.
Okay, well, thanks for that, Jenny. And actually, one of the most fascinating photos I've seen in all of this has actually been a Lagos without traffic, which I never thought I would see. So let's move on to AO and talk a bit about more on the liquid side of African equities.
Thank you very much, Dan. Well, I mean, I suppose we've been okay in terms of the impact that this disruption has had on our fund. It's not been satisfactory, but I suppose it's one of those things where we say it could have been worse. If I've learned anything in the times that I've been covering African markets, it seems to be that when there's a party going on in the global equity market, the invitation sent to Africa comes by second-class mail. But when there's a funeral, they send an Uber to pick us up and make sure we're right there in the center of the, we're right there as the chief mourner at that funeral, because whether one is the performance of any of us on this in this period would really be critical about how you were positioned going into it. If you were fortunate and you had a healthy cash balance, then it would be okay, because there's not enough liquidity to be able to switch tactically when you see the train coming. There's just not enough liquidity. You know there's going to be a crash, but you can't. If you need to be positioned maybe a month, maybe 2 months, maybe a whole quarter, maybe several quarters ahead of it. And if you were not, then you can't actually switch that. It's not a market where you can switch tactically and make changes to your portfolio that will be radical enough for you to be able to avoid the worst of these type of things. So, maybe partly because of home country bias or whatever, we had pretty decent exposure to Nigeria, and we'll be talking to Emefiele about that when I get a chance, whenever the chance occurs. So overall, our portfolio, I think we coped well in relation to the index, but it was more the fact that our tactical positioning going into this period was not optimal. And so in terms of the impact, we couldn't change quickly enough. And then it becomes a question of, well, is it too late to sell, or is it too early to start? Is it too late to sell or too early to buy? We were fortunate that in terms of our holdings, we had quite a decent exposure in the credit markets, and although there was stress in the credit market as well, it wasn't as bad as the stress which we felt in the equity markets. And also, we happen to have a higher exposure to sort of stocks in Eastern Africa, where I think the decline in oil price has helped with their balance sheets. But then, our West Africa exposure has not done us much good. So overall, I would probably say we're just fair. We lost an arm, but we didn't lose a leg. Daniel, on mute. You are on mute. I think Daniel is on mute.
Okay, Dan, I'm sure you want me to go now because I'm the last one. So let me go. Sorry, I wasn't sure if you were going to invite me or not invite me. Great. Yes, I think the one thing, I hear what all my sort of, other investors in the continent are saying, and everyone has very valid points. The one thing I think that we forget a little bit, because COVID is so important now, and we're all thinking about COVID, is that going into this COVID thing was we were sitting with a period in the world where we had much higher rhetoric around US-China trade war, not trade war, and how that was going to unfold. And we were all sort of busy trying to deal with exactly what that meant for Africa, whether China was more involved, less involved, whether we were going to see the US, where the different changes was. And commodity prices had sort of, well, it recovered, but it wasn't, we didn't know it was going to go down or up. So it was a very interesting time, and COVID came, and it was something was no one expected. I mean, no one really thought it was going to happen. And I think that's overlaid on top of this US-China trade war and this issue that we're having. And it's a further complication in terms of, do we sort of carry on? One of the things we saw in COVID in all countries was this just-in-time producing things for the shops, and that was maybe we saw some of the problems with that. We saw some of the issues with where you get your supplies of various things through. So are we going to see that change? How does that then come through into Africa? Will Africa sort of be able to produce more things for the rest of the world, or are they going to sort of still be a little bit slower and people are going to buy their commodities and try to produce more things in their own countries? And then, of course, one of the big things that we've seen from this is tourism. Tourism really has slowed down. All airlines in the world are sort of trying to get rescued now because no one's flying anywhere. And I think tourism will take some time to come back. It obviously affects different countries in different ways. Nigeria wasn't really important in terms of tourism, but the oil price, which was a factor, was really important to Nigeria. While some people like Kenya and Mauritius, for instance, tourism was really, really important. I think, along with most of us in Africa, we tend to focus on companies that are stronger. We look for companies also have a decent amount of liquidity because we run a UCITS fund, so we need some sort of liquidity in what we're doing. So we have high liquidity companies. On a global scale, that means low liquidity, of course, because as I said, we don't sort of really benefit from huge amounts of liquidity in the markets. But I think the positioning now is we have to decide what's going to happen, how the world is going to recover. And we had some cash going in. We took a bit more cash going out, not a huge amount because we didn't want to push down prices on what we were in. And we now effectively sort of putting it into usage where we see interesting stocks that we think can bounce back from where we are. We have seen markets come up a bit already, but not by a huge amount, not back to where they were before COVID.
Okay, well, thanks for that. I think what's interesting is looking at all the various markets, and we've got different strategies here. We've got full Africa and we've got Africa ex-South Africa. But clearly, because South Africa is a more liquid market and because there's been a totally more orchestrated response in South Africa to the lockdown, I wonder whether there's going to be a bifurcation in effectively performance between South Africa and the rest of Africa for the period going forward. I don't know who would like to try to field that first.
If it's okay, I'll have a chat about it quickly. I'm not sure that there's going to be such a huge effect due to that, because I think that we don't realize how early we still are in terms of COVID. So I think that COVID is going to be with us for at least this year, potentially for the next couple of years as well. I see tremendous challenges in delivering a vaccine. Firstly, finding a vaccine that will actually vaccinate people for a long period of time could be challenging, and not just give them a short-term period. And then once let's say we do find a vaccine, producing, delivering and giving it to people is going to be challenging. So, but at the same time, I think that when we went into the lockdown in South Africa, where I'm based in South Africa, we were thinking of we didn't know as much as we do now. Now we still have a lot of things that we don't know, but we'd seen what happened in Italy. The fear was that in Africa we have comorbidities that are just going to be even worse than Italy. We have no choice but to be in a very strong lockdown. And I think that the result has come out now that, yes, COVID is very serious, it's really important, but we have to be very careful how we balance the economy versus the lockdown versus the different things going forward. So I think in South Africa, we have had it. I think the other countries have had very similar, even though they might have had shorter lockdowns. I think that this similar thing has happened. So I don't think really there's a difference between South Africa and the rest. I think it's much more nuanced than that. And you'll see that countries that benefit from certain things, like for instance Kenya, which maybe we'll be able to produce, export its agricultural goods, assuming that the locusts don't come any further south, and maybe benefited from low oil prices, will do okay. And Nigeria, where the oil price was down, maybe not so good. And then Mauritius, where tourism is a big factor and can take a long time to come back, might be challenged for quite some time.
I mean, I think, I would agree with a lot of what Sven said there. But I think if we're looking at the performance of risk assets in South Africa relative to the rest of Africa, the anomaly with South Africa is what I call, or there are plenty of stocks which are listed on the JSE, which are not actually South African stocks. They have the drivers of their performance have absolutely nothing to do with South Africa. So, you've got Naspers being the biggest company on the JSE, whereas it's actually a China, it's more exposed to events which are happening in China. So in terms of economic performance, I don't think that South Africa would probably outperform on a GDP. If you were looking at domestic GDP growth relative to the rest of Africa, I think they face pretty much, South Africa and what I call frontier Africa face pretty much the same stresses. South Africa has the advantage that it has a far more developed financial market, but then it went into this crisis, with higher debt levels for the government, a fiscal constrained position, and even challenges on the supply side with ESCOM and things of that nature. And so the economic performance, I think, will probably be similar. But the risk asset performance, I think, will be different because South Africa does have the advantage that it has these what I would call tech companies or technology-driven stocks, which are not their primary drivers are not in South Africa, but they're still listed on the JSE. And even when you look at the global market, we've talked about a recovery to date. The recovery has been pretty shallow. It's been driven a lot by tech stocks. Even on the S&P 500, about 60% of the stocks in the S&P 500 are still in bear market territory. So once you strip out Google, when you strip out big tech out of it, you actually don't, you strip out big tech and then you strip out what I call the zombie companies, bankrupt companies which have been rallying heavily in the last few weeks. Actually, it's not a broad-based recovery. So at a risk asset level, South Africa might actually, has something, has some variables which would allow it to outperform, and that's primarily the non-SA stocks listed in South Africa, but which derive their economic drivers from outside the continent. So if you're talking about Naspers, you're talking about Old Mutual, you're talking about Sasso, those companies could drive the outperformance of the JSE over the rest of Africa, but primarily just because of where their economic exposure is. But at the economic level, if you're talking about performance of the domestic economy, I would agree with Sven. I think the economic performance would be nuanced. It will be country specific, but I don't think South Africa has some built-in advantage that means that the economy would outperform.
Yeah, just to jump in there as well, I absolutely endorse Io and Sven's perspective of this. I think it's definitely going to be much more nuanced. I actually would argue that South Africa, from an economic perspective, their lockdown has been much more severe than we've seen in most of the rest of Africa, where really it's been more of a combination of locking down cities and curfews more than anything else. And so I would actually argue that the economic impact on the economy in South Africa is likely to be worse. I think that if you're looking across the rest of Africa, I would then say it looks to me like it'll be Kenya, Egypt, where lockdowns haven't been as severe. I'm not saying that they've obviously will take the wind out of the sails and certainly put quite a big pause on economic growth, but hopefully not to recessionary levels. So I think there's a much more nuanced economic profile across the continent, with Nigeria, unfortunately, at the wrong end of that, as we discussed earlier.
I don't think we can ask everyone their top 5 picks, but what I would do is ask each one what they think is the most winning stock in their portfolio in this scenario. So, whether it's Safaricom or whether it's Napster or whatever. I think let's start with Sven, because he hasn't said something for a while.
I think the stock that for us has actually probably been one of the best ones in this thing has been Safaricom. Actually, we've had a high weighting, and it's done very well for us. Being rather defensive in obviously this type of environment, and it's probably one of the ones where you have most certainty as to what its future holds as such. You know, where banks, you have some issue with what their bad debts might be and things like that. But Safaricom has actually got certainty, and it's done quite well.
So it's still very, very robust. Richard?
Similar sector, well, same sector, telcos, but some of the stocks that we're most excited about are, shall we say, the expected returns or expected performance is not due to a recovery specifically from COVID-19. It's rather company-specific issues. So we've had quite a large holding in Telecom Egypt, having done quite a lot of work around that one, and it's performed very, very well. In fact, it's being in a positive territory year to date. Another one is Eastern Tobacco in Egypt. So I suppose to some extent a theme coming through here with Jenny also mentioning that she quite likes Egypt. But in both instances, it's not necessarily about a beta play, a big recovery play. It's company-specific factors that we expect to drive those returns.
Okay. Jenny?
Yeah, that's a good question. I agree with Sven. I think Safaricom has really been a good, solid position. I think it really speaks to obviously the opportunity, the obviously the data usage, and which has obviously increased, and the e-commerce platform and all of those kind of things. So that's been really good for us. I think looking elsewhere, we've also had some quite good attribution from our healthcare exposure in Egypt as well, which we've been fortunate enough to have. I wish we'd had Egypt Telecom because we've watched that too. And then we've also tried to broaden our telco exposure rather across these markets, adding to things like MTN in Nigeria when it's been lower. And so that's been a really nice source of attribution because we were able to put some cash to work there. And so, yes, that's really been a driving theme for us. I think we've almost doubled our telco exposure during this period.
The telco sector is definitely, you know, if you're for defensive posturing in Africa today, there isn't much else that would give you. They are unfortunately our equivalent of tech stocks. You know, they're the closest we have in our broad market to tech stocks. So you would definitely expect to see most African portfolios would have significant exposure to Safaricom, Egypt Telecom, Sonatel. So I mean, probably more on the basis of our approach, which is that we sort of look at value as the philosophy that drives our portfolio. I don't know whether I will see how if I'm still in business a year from now, then it would have been a good call. And if I'm not in business, then you would know I had no business being here in the first place. Is that we've actually been buying the banks. I know everybody would say bank. I mean, both in Europe and in the developed world, that they are going to be the key ones who will bear a significant amount of the brunt of these of the challenges from COVID in terms of their NPLs, and undoubtedly NPLs for the banks are going to go up. But when we look at African banks, I mean, it's rare, to find an African bank these days that trades on a PE above 6. And on average, most of them would have an return on equity. I mean, okay, it's going to go down this year, but their sustainable return on equity tends to sit somewhere around between the 18 and 24% level. So and what we've seen in the world today is that the cost of capital is coming down. So I sort of begin to think that, well, maybe the pessimism around the banking sector is overdone. Maybe we'll have 1 year hit in earnings. And they have the ridiculous advantage that even whether they're in their office or they're not in their office, they're accumulating interest on their loan books. So we've actually, we've been buying Kenyan banks, KCB in particular. We've also, God help me, we've bought some GTB in Nigeria. It's a good bank. We all, most people, one of the best run banks, I think, in Nigeria. But it comes with the Naira exposure, with the Naira risk, and also, surprisingly, a bank which hasn't. We know about it, but people have not. I've not seen a lot of interest in it. Has been CRDB in Tanzania. The bank has had challenges and problems in the past, and Tanzania has not yet recovered from President Magufuli's anti-corruption drive. But I don't know whether, I'm skeptical about the GDP numbers that come out of Tanzania, but if they tell us that the economy is growing by 6%, even if you're skeptical, maybe it's growing by 3, maybe it's growing by 2, but it is growing. And, there's some kind of growth there. And the Kenya, I just think if one's looking for places that might be off the beaten track, maybe Tanzania might be a place to look at. So we've actually got quite a decent exposure to CRDB. It's one of my colleagues calls it the kamikaze bet that we put in the portfolio. We'll find out whether how that works out. But as of today, our exposure is actually now almost 50% in the banking sector.
Thanks. I think with the banking sector, that's also a bet on the duration of how long this goes on for, which obviously we don't want to talk too much about the actual virus itself. There's a question here from Abiamayu. He's worried about country credit ratings, and a few people have mentioned Nigeria and the declining oil prices and debt sustainability. There's a whole lot of questions that are at the edge of the equity markets that all of a sudden take sort of front seat for a change. So I was just wondering if maybe we should just touch on debt sustainability and what countries, what the message is to equity markets in this situation. Who wants to go first on that?
Well, I could start. Or Richard disappears. Richard, do you want to go first? Okay. There are some obvious countries which have, going into this crisis, had debt stress levels anyway. Angola, Zambia would probably be the two most obvious ones. A lot of the other African countries went into these with, their debt levels were, I wouldn't say overstretched. They were at the limits of what they could afford, and they needed to continue. They would have needed GDP growth of around somewhere between 4 to 5% to be able to manage those, the debt burdens that they had, and that's now no longer realistic. But the problem about debt forgiveness is going to be a challenge, because if we were to go back to the challenges that Africa had with debt in the 1980s and 1990s, a lot of that debt was to banks and to governments. And so it was possible to get coordinated action going because of it wasn't that difficult to corral the banks and governments together to come up with a solution. Today, a lot of the debt that Africa holds or Africa has is commercial debt. It's either Euro bonds or it's to the China Export-Import Bank. It's more of a commercial nature, where to a diffuse body of holders. So getting any kind of agreement among these holders for debt restructuring would be difficult. For debt forgiveness, I think would be impossible. I don't think you would be able to get anything. And also, I'm not even sure whether debt forgiveness would be useful, because with debt forgiveness, then you would have to go into the rating agencies would regard that as a technical default, and then that means that the country involved will then be shut out from the debt. Will be shut out from the public markets when this crisis is over. So I don't think we would have much we will certainly see countries getting their ratings downgraded, but I'm not sure that country ratings have ever been a big part of the way African debt was priced. Rwandan debt, Nigerian debt, Zambian debt, they all get priced almost as if it was one analogous thing. So the ratings don't make much of a difference. What I think you would probably need, or what we are more likely to see, is some of the commercial debt, maybe from the big holders like China, being restructured. But I don't think anything will happen on the publicly traded debt. I think those Europe, I know there's a working group and there is a plans around the G20, but the chances that those talks could lead to any formal resolution, I think, are very, very low. And what you would end up having is that the commercial debt, which is not owed to government, would have to be paid in full. And then any restructuring would just have to be done at a government-to-government level. And where that doesn't happen, then the holders of the commercial debt took a risk. US T-bills were yielding under 1%. You lent money to an African country at 8 or 9%. There was a risk involved. And if it has to default, then you take a risk and you take the haircut, and that country will be shut out of the debt markets for whatever period of time, or there will be a default. But I don't think that we would see debt forgiveness. We will probably see restructuring of debts owed to government institutions. But I struggle to see how you would get Eurobond holders, even with collective action clauses in the Eurobonds, to all agree on a way forward for the restructuring of those non-government debt.
Yeah, they've probably got other things to worry about at the moment as well. So Richard, you wanted to chip in there?
Yeah, so I mean, I agree with almost all of what Aro had to say. I completely agree. I think that we do have to think about the fact that the reality is that there are some countries on the continent with debt problems, and I agree with the reasons as to why it would be incredibly difficult to have debt forgiveness, but that, of course, as investors makes us to think, well, what is the impact going to be? Obviously, the initial impact on the economy comes through the exchange rates. If a country does hit significant debt sustainability issues, typically you'd have inflation coming through with a weaker exchange rate. So to bring it to how we think about it from an equity investments perspective, our philosophy is we look at the fundamentals of the company, so call it bottom-up analysis in typical industry jargon, but we overlay that with a significant macro analysis and understanding what's genuinely driving the macro economies and the macro drivers. So if we're looking at the continent, we have to look at the countries with significant debt issues and those that have relied on Eurobond issuances or foreign borrowings, perhaps to support the exchange rates, perhaps to some extent corporates and therefore consumers have been benefiting from a, in inverted commas, subsidy where your exchange rate is stronger than what it should be, and therefore affordability is better, and therefore perhaps consumer companies have been in a better position where their consumers have simply been able to better afford their products. So to make a call on whether there will be debt write-offs or forgiveness, I would say I think we'd focus on the fundamentals, focus on those countries which potentially aren't in difficulty, and even those that aren't yet in difficulty, because I tend to agree with Sven. I think Corona or COVID could be around for an impact in the African continent for well beyond the end of this year. So we do need to think longer term in terms of the sustainability of fiscal positions and how that impacts the current accounts and balance of payments, etc.
There was a question on.
Sorry, I'll just add that while I mean, I agree with that, and debt is very important. I think, one of the things that we probably, think about it, but we have to think also very closely with inflation and currency values in the country. That can have a more immediate and quicker effect on us in the next 6 months.
Yeah, I think also, just in this whole debt debate, China is a large holder of African debt, I think up to about 20% of sub-Saharan's debt in total. And so they're going to be a key player here. I think so far in the posturing, it doesn't sound like they are open to debt forgiveness, but potentially there's some form of restructuring. And I think in particular to the countries with higher debt levels, like the Angolas, the Zambias, who have a significant amount of Chinese debt as well. It's going to be interesting to see. But again, this to Richard's point, I think it's really important to understand the macro overlay for each country prior to making an investment.
One thing that I would like to send a message to all African governments is that the Chinese and the Chinese debt is on commercial terms because they would like to benefit China at the end of the day. As would Western debt be as well, but China debt should be alongside all other debt, and they will take the interest and they will possibly, as I say, restructure, but they will take their debt back and they will build things in order to make money. They are just one of the others involved in Africa, nothing special, and some African countries seem to forget that.
Yeah, although they, as a country, are coming out of this COVID a little better in shape than others. There was a question on wild swings in markets, which I'll translate into being, is the volatility over? I don't know if anyone wants to sort of dare to address that one, because it does seem to be that we will now know more about the future, so that tends to bring volatility down. But is anyone afraid of a second wave of volatility?
Yeah, I think there's likely to be a second wave of volatility as we see results coming through. Maybe not quite as volatile as we saw in March, but I think a lot of the markets have already priced in, maybe not so much from an Africa perspective, but I think that even some names specifically have had quite a good run. And so I think that there might still be some shock when we see the impact coming through, in particular in the banking sector. So I support you in terms of your degree. And I think that in a lot of countries, these banks have gone into this crisis with fairly liquid balance sheets. But for me, it's a concern that as these banks start to having to report the NPL ratios coming through, I think that could be a rather negative shock in the short term. So I'm concerned that second quarter reporting or first half reporting could be another cause of further volatility. And then, of course, we don't really know what the future looks like for this virus, and whether there will be a second wave, and that could also, I would imagine, then potentially create further volatility.
Yeah, I think also one of the things we have to think about is that we've had, on a worldwide basis, we've had financial markets come back very quickly because of a lot of stimulus, but you're still seeing companies that don't have any business going bankrupt. And these two things don't always touch quite perfectly. So I think as we get information, it's going to be volatile in the world, and that volatility will overflow into every other sector as well, whether it's emerging markets, frontier markets, etc.
Okay. So there's a question from Todd here on whether if we can dive deeper into Nigeria. Again, Nigeria has obviously got issues on the oil price and a number of other issues which we've already touched on. But is there specific issues about Nigerian risk to the Naira itself that anyone wants to sort of flag or touch on?
I think that Nigeria needs to have a devaluation. That's self-evident. That Nigeria will have a devaluation, that's a different, that's a completely different question. Whether the devaluation whether they will allow that to happen, because there are a whole bunch of different variables at play with Nigeria. And it's a politically sensitive issue. So at the moment, they seem, there seems to be a little bit of wind blowing in their favor because the oil price has partly recovered. But even if, there were concerns with the Naira even before we started going into COVID. If you simply went back to Economics 101, they did the deval or the reset in 2016, at which we moved from about 190 something or just under 200, we moved to 360 Naira to the dollar. Since 2016, if you looked at it, the Nigerian economy has been running an inflation rate of about 10% a year relative to the dollar. So just on that, if, forget COVID, forget anything else. If you just looked at that, look, if the reset was done in 2016, and since then you've had 30% cumulative or almost 40% cumulative depreciation, inflation differential, then that tells me that the Naira should be getting closer to 450 just on simple PPP calculation against its main trading power. So whether with COVID or without COVID, all COVID has done is brought the day of reckoning forward. So long as oil prices were high and the dollars were flowing in, they could have kept that overvalued exchange rate going. And COVID has just sort of exposed that structural weakness in the Naira. Now, as to the political decision of whether they will do the deval, I mean, I guess I would say, like Winston Churchill said of the Americans, they'll do the right thing after they've tried every possible alternative. I think you can say the same thing of Emefiele. He will try everything else, and then when it becomes inevitable, he will finally give up and do the right thing. But inflation differential suggests and tells me that at some point, I can't see the Naira trading below 450 in the official market. How quickly we get there, I think they're going to slow walk it. They're going to keep the queue in place. They're going to do, demand management. All the same tricks that we saw in 2015, 2016 is going to deploy the full panoply of those policies. But eventually, at some point, they will have to do the inevitable. But if we take another 6 months, I don't know. I mean, the smart thing to do, I think, the catalyst I would imagine would be if the economy were to go back into a recession, and and that then crushed the supply side in terms of companies in Nigeria not having access to dollars, and then that starts to have a real impact on output. At the moment, that's not yet happening, so he will. I think they will keep, they will keep this current process of trickling money into the economy and trickling dollars. And as for foreign investors, well, he'll just tell us to, cool it and wait in line and investing in Africa, as I always said to some of my clients, is put the money in there for your grandchildren. I think in Nigeria, we've got to start thinking of our great-great-grandchildren. Sooner or later, somebody will get that money out, but maybe it's not going to be us.
I saw some good news on Nigeria that they're getting the cost of break-even oil extraction down quite significantly. So just to remain positive. Talking about positive and so forth, if the news actually showed anything other than what it does these days, I would be seeing pictures of locust plagues and so forth hitting Kenya and Somalia and the like. Is that a real concern, or is that just something which is dramatic from a pictorial sense? Sven, you're on mute. Yep.
Am I on mute?
Oh, I can hear you now. Yep.
Okay, sorry, I wasn't on, but maybe Roman put me off. I'm sorry. For us, any food insecurity north of Kenya, to me, must be a potential instability for people who want to come across the border, possibly more, fighting or something like that. So that's a concern. So far, we don't know exactly what's going to happen, but luckily, the locusts in Kenya seem mainly in the north as such and haven't really moved down very far. But no one knows. And if they do move down, agriculture is very important for Kenya, and it'll be very important for us.
Yeah, I think just to potentially add to what Sven has said, I think Kenya has been protected so far in that the bread basket hasn't really seen the locust plague yet. But as he rightly points out, we don't know. I think, at the moment, and just to speak, Sven touched on it a little bit, we work with a number of SMEs through a Women Impact Fund as well that we run. And we have really seen huge supply side. The supply side impacted enormously just because of the export routes that have really shut down as a result of COVID. And that has been a really major crisis for a lot of these SMEs. And so somewhat concerned about that ongoing impact into that and the sustainability of some of those businesses that have been growing things like mange 2, baby carrots, corn, little baby corn, for really the export market. They don't have a real natural market for that in Kenya. And most of that product or that produce was exported in the cargo hold of passenger planes. And so really the only cargo flights that we're seeing leaving Kenya initially, certainly that's easing, it's changing a little bit, but have been cargo flights for the cut flowers into Amsterdam. And so that has really created quite an uncomfortable situation for these farmers, where they have had no market for their produce. They've had to continue to produce, but no revenue coming in. So I think that now, and potentially with a potential locust invasion, could have caused some economic uncertainty in that part of the region as well.
It's slowly running out of time, but I did say I would return to the question of liquidity in underlying equities, and I think we've all touched on it a little bit, talking about asset allocation not being able to do big shifts or whatever. But what is it like once you start getting below the sort of the large capitalization stocks? What's liquidity become like in Africa right now?
I'll give it a go.
Sure.
And just sort of tying it in with the earlier question on, do we expect significant volatility or further volatility? To the point is that the more liquid names, which typically are also held by emerging market investors or other frontier investors, so your Safaricom's, Komi, CIB Bank in Egypt, for example, you may well see a lot of volatility in those more liquid names. But bringing to your point on the stuff slightly more off the beaten track, we've been quite fortunate to pick up what we think are very attractive investments over the last few weeks, where they're clearly investors who I think are selling more for liquidity reasons than necessarily a view on fundamental valuation. So you've seen a few stocks in the smaller markets, call them the tier 2 markets, so Ghana, Tanzania, etc., where they're pockets of trade, blocks of trade, for want of a better term, where we are able to pick up value where owing to the liquidity that we have in our fund at the moment. So you will see significant moves, but arguably the stocks weren't necessarily, the previous pricing that you saw was not genuine pricing because there wasn't significant trade going through there. But now that we are starting to see more serious sellers coming into some of these names, you will see big price movements.
Okay. That sounds, there won't be much disagreement on that. So let's just go around the panel and get any final thoughts on what we've been discussing. So starting with Jenny.
Yeah, I think I think the outlook is obviously still fairly unclear. I think it is going to be very much a more nuanced approach in terms of the various economies. We have a small preference for Egypt and the East African economies, less so than the oil-producing nations. Although I would say that, and just as a reminder, we all know that Africans is a resilient population. They are early adopters, in particular from a technology perspective. In fact, one could argue that they were the leaders in mobile money, and so that has really put them, I think, ahead of the race in a lot of this from that perspective. And I think that's going to continue. We're going to continue to see technology driving these things and driving the economies and more adoption. So yeah, we are cautiously optimistic. I think you need to be careful. It's definitely going to be more about picking companies than picking countries or sectors going forward. Yeah.
Okay, thank you. And I have fingers crossed on the banks.
as we invest, we read the Bible and the Quran and everything, whatever else we can find. I mean, I'm actually, it might sound like I'm talking our own book here, but my expectation is that on the economic side, the African economies will probably perform much better than even the World Bank numbers are currently, the projections that are coming through from the World Bank. Because although a lot of these countries announced lockdowns, the effectiveness of the lockdown was different. It was varied. How up to what extent it was enforced, and the challenge was always the fact that you don't have free cash transfers in Africa. You don't have, governments are not able to provide the same kind of fiscal stimulus and, pay wages and unemployment. Essentially in Africa, if you wake up in the morning, if you don't work, you don't eat. It's that rule. It's a very simple rule. And most people are they're either on day wage, they earn their wages daily or weekly, but they don't have the luxury of being in lockdown for 2 months or 3 months without working or earning anything. And so I think the lockdown has been, it's been a system shock, but probably actually when we start to get the real GDP numbers, we will find that what it has done is it has slowed growth rather than led to countries being in a recession. What I'm more worried about is because we are dollar investors, I think if COVID is going to when COVID is finally going to go through, and the main impact it will have on our portfolios will be via currency exchange rates rather than via the actual local currency returns. I think we are more likely to see currency weakness, and it will be the currency weakness that will cause damage in the long run rather than the domestic local equity prices. So in that
avoid overrunning, so just give Sven a chance for final comments here. Richard?
My turn. Yeah, absolutely. So essentially, the structural reasons that we invest in the African continent, the belief we have in the long-term economic growth, and the belief in the quality of the corporates that are able to not dominate, but benefit from that growth and generate very attractive returns on invested capital is still there. COVID-19 is an impact, and it is a factor that's going to impact these businesses over the medium term. But to some extent, I think the really good quality businesses perhaps could even benefit from this, where they deal with the crisis better and earn market share and gain market share. So we remain very optimistic on the long-term investment opportunity on the African continent. We do note that it's by far the cheapest market in the world, single-digit PEs. There's no other indice that's on single-digit PEs, highest dividend yields, and yet also highest return on invested capital, highest ROEs. So, cautious, position yourself appropriately given the current scenario, but don't lose sight of the longer-term picture.
Excellent. The triumph of the optimists. Sven?
Yeah, sort of basically very similar. We have seen companies here which have more customers, more business, and they keep growing as the economies grow around them. And we've seen Africa starved of liquidity. Prices have gone down, PEs have got cheaper, so the E keeps going up, the P keeps coming down. We think that has to reverse at some stage. I can't tell you when it's going to happen, but it's going to happen very suddenly at some stage.
Great. Well, that was actually bang on time. So thank you, everyone. This webinar recording will be posted on the webinar page of africaglobalfunds.com. And let's hope that it is the triumph of the optimists. Thank you.
Thanks very much.